So, hi folks, welcome to the Goldcast. Today I'm joined by Chris Powell. He is a professional journalist and secretary and treasurer of the Gold Antitrust Action Committee. So thanks, Chris, for coming on today.
Oh, great to be with you, Meyer.
So I guess tell us a little bit about how you came into all this information in terms of gold and price rigging and all that stuff, and why you founded the GATA, as it's called sometimes.
Well, it was all kind of an accident. Back in, I guess, 1998, I was looking at contrarian investment options, and I subscribed to a number of financial letters. I think I answered an ad in the Wall Street Journal or something like that, where you send somebody $10 and they get you a dozen free trial subscriptions. One of the letters I got was Jim Blanchard's Gold newsletter, which is now run by Brian London, because Blanchard died shortly after I subscribed. Blanchard was saying that gold was really low at the time. This was in '98. Somewhere I had heard buy low and sell high, so I started following the gold market. I very quickly ran into the internet site of GATA's chairman, or he's now GATA's chairman, Bill Murphy, who's a former futures trader. Bill was writing almost every day about how it seemed that the gold market was rigged because of certain things that happened when the gold price reached technical points that were important to traders. And Bill saw that the same bullion banks seemed to be intervening in the market to prevent the price from rising at crucial points. I had some experience with antitrust law because of my newspaper work. Our paper is a small family-owned paper that was always really being attacked by big chain-owned papers that were trying to prevent us from getting important syndicated features, and we had to bring antitrust litigation off and on against them. So I had some background in antitrust law, and I wrote to Bill saying I was getting rather tired of his complaining about the market being rigged, because if it was being rigged, I told him it was probably against the Sherman Act and the Clayton Act and 50 state antitrust acts, and if so, somebody ought to form a committee and hire an antitrust law firm on a contingency basis and sue the market riggers for triple damages under antitrust law. And I told them that if somebody wanted to start such a committee, I would donate $500 to it. Bill thought that was a good idea, so we started such a committee and got it incorporated in Delaware in early 1999. And we hired an antitrust law firm with a very generous contribution we got from a South African mining entrepreneur. And the law firm very quickly found out for us that it looked like market rigging was completely legal if it was done by the US government in gold, because the Gold Reserve Act of 1934 gave the Treasury Department and the Exchange Stabilization Fund the power to intervene in the gold market. And given that the government had that power, the law firm thought that it was very unlikely that an antitrust lawsuit would succeed. And at that point, we concluded that probably the most we can do here is just clamor against what the government was doing, try to expose it. We began very quickly to realize that the bullion banks, the investment banks that trade in the gold market, that dominate the gold market, were not really doing it for their own book, that they were doing it as the agents for the US government and other governments. And if the government was really behind the whole policy, then all we could do was clamor against it and perhaps bring freedom of information cases against the government to uncover certain documentation. And that's what we've been doing for 20 years. We have uncovered enormous documentation, really from government archives themselves and statements by central bankers in ordinary course of their business and in their memoirs, confirming that gold price suppression has been Western central bank policy for at least a half a century. But we found it almost impossible to get mainstream financial news organizations to look into the issue. It seems to be considered a matter of national security in the West.
Right, right. So, when did you hear about the London pool? Because that was actually something I learned through your website, and it seems like pretty much the rigging of the gold price was just an openly done thing for a long time,
Yes, yeah,
before the Bretton Woods Agreement.
that's exactly it. It used to be very open public policy through the London
Right.
Gold Pool from 1960 to, I think, March 1968. That was where the United States and I think 7 other governments in Europe got together in a scheme of dishoarding their gold reserves through the London gold market as necessary to hold the public gold price to the $35 an ounce set by the Bretton Woods Agreement in 1944. In 1968, the pool began to come under great stress because investors began to realize that the gold price really should be a lot higher, given the amount of money creation that was going on and the amount of spending in the United States by the government on the Vietnam War and social programs. And there began to be a great amount of offtake of gold from the London gold pool, and then France broke away from it. And the participating governments began to realize they had only a few months of gold reserves left if the offtake continued at these levels. And for a while, the United States was flying emergency Air Force cargo plane shipments of gold from Fort Knox over to the Bank of England in London, because the Bank of England was advancing its own gold to the gold pool on the credit of the United States. The offtake became too big as people realized gold was underpriced and began to take it away from the gold pool. And I believe it was in March 1968 where the United States government asked the British government to close the London gold pool. And we had a brief few years of a more or less free trading gold price before the U.S. and its allies decided to encourage the operation of a gold futures market, which made it much easier for big players, including the governments, to control the gold price because it could use leverage. It could use what's called paper gold. It did not have to spend so much gold from national reserves to keep the price down. It could sell virtually infinite amounts of imaginary gold, and as long as the mainstream financial press didn't point this out, the public could be fooled.
Yeah, exactly. And so why do you think they chose to end it like that and just end the Bretton Woods Agreement? If there was kind of a run on gold and they couldn't keep it at the price of $35, why wouldn't they just increase the price?
If they increased the price, they would be devaluing their currencies against gold. They would be really impugning their own currencies against gold. And sometimes governments do that. Governments use gold for devaluation purposes. Now, the gold wasn't completely delinked from the Western currency system until 1971. The gold pool closed in 1968. So we had a few years between the closing the gold pool and the total removal of gold from the Western financial system. And then it was really another 3 years before the futures market in gold was created in New York. So that intervening period, there was more volatility and fluctuation of the gold price because governments had not yet settled on new mechanisms of price control. But once the gold futures market was established in New York in, I guess, 1974, they had another mechanism that could be used for gold price suppression.
Yeah. So you mentioned earlier the Gold Reserve Act and how it gives the Treasury and the Exchange Stabilization Fund the ability to trade gold and affect the price, obviously. So what is the Exchange Stabilization Fund, and what is the Gold Reserve Act, and what is all of this? What was the point of it originally, and how is it being used today?
Well, the Exchange Stabilization Fund is basically the mechanism of currency market intervention under the Treasury Department. It is basically the Treasury Department. It's an office in the Treasury Department. Many countries have similar agencies. Britain has had one, I think, just as long, if not longer, than the United States. in the UK, they call it the Exchange Stabilization or Equalization account, something like that. It's just the Office for Currency Intervention. It's not well understood. It's not much reported. Mainstream financial news organizations tend not to ask any questions about it, but it's simply the office that intervenes in currency markets when governments don't like what markets are doing.
Yeah. Has your organization been able to get any documents out of that particular department of the Treasury using the Freedom of Information Act?
Well, the Exchange Stabilization Fund does issue an annual report, but it's, I think, very sanitized. And I'm not sure if the fund has a specific exemption from the Freedom of Information Act, but the law setting it up says it's not accountable to anyone but the Secretary of the Treasury and the President. So, even Congress can't really get much out of it. We have brought Freedom of Information actions against the Federal Reserve. In fact, we won a case against the Federal Reserve to gain access to some of its gold records. We didn't get many gold records, but the U.S. District Court for the District of Columbia ruled that at least one record that we wanted that had been withheld from us, minutes of a G10 Gold and Foreign Exchange Committee meeting some years ago, should not have been withheld from us. And so technically, we won the case. People say don't fight the Fed. Well, we did fight the Fed, and we did beat them. And we proudly display on our internet site a check from the Federal Reserve Bank of Richmond, Virginia, where they had to pay us something like $2,500 in court costs. So we did beat the Federal Reserve in a Freedom of Information case a few years ago. But as a practical matter, the Fed really won because the court ruled that most of the documents, most of the gold documents that the Fed wanted to keep secret were properly kept secret. So as a practical matter, the Fed won. As a technical and legal matter, we won, and we have the check to prove it. Most interesting about that case, though, was a letter that a member of the Federal Reserve Board, kind of acting as a hearing officer on our complaint, wrote to our lawyer in the course of the adjudication of these documents, in which the Fed's governor admitted that the Fed has secret gold swap arrangements with foreign banks and will never disclose them. That is, the Fed in this litigation confirmed that it is, if not intervening in the gold market, it has arrangements to intervene secretly in the gold market. Now we have a whole bunch of other documents that show this, but the litigation did extract an admission from the Fed that it has secret arrangements to intervene in the gold market with foreign banks. So, it's just more documentation that we've extracted from the government, and we've published in our documentation file on the internet site to really prove what I think ought to be just a truism, that central banks intervene constantly in the currency markets, and particularly the gold market. And they usually do this surreptitiously, because if the markets found out what was going on, the markets would not be deceived and would not be fooled into acting as the government wants them to act.
Right. Yeah. So, what percentage of, positions in the physical markets, quote unquote, and also the futures markets, do you think are held by central banks?
Well, I think the various governments, are the dominant players in all aspects of the gold market, including the futures markets. We cannot tell what share of any part of trading central banks are responsible for. We do know that the great bulk of trading in the gold futures markets is just paper trading. Until recently, there hasn't been a lot of physical delivery in the futures market. There's been a lot of what you might call spoofing, the imitation of trading to control the prices that are reported publicly. We can't say, we don't know, because so much is secret, exactly how much trading is central bank trading. We do know that there is central bank trading. We do know from the monthly reports of the Bank for International Settlements, which is really the central bank of the central banks, really the gold broker for the central banks. The BIS's monthly report in the footnotes describes the bank's gold trading position, or at least its gold trading can be deduced by some arithmetic in its footnotes. And those monthly reports show that the BIS is actively trading on behalf of its members surreptitiously in the gold market every month. And indeed, as of May, our consultant on the BIS, Robert Lamborn, had calculated that as of May, the BIS's intervention in the gold market on behalf of its members' central banks had reached its highest point in 3 years. Now, there's documentation. A few years ago, I asked the BIS press office, hey, could you tell us what are you doing in the gold market? What sort of trading are you doing with swaps and derivatives, and for whom are you doing it, and what's the objective here? And I got a very polite note, really, I think within a day, saying that, oh, they don't talk about that kind of stuff, and I should go ask central banks. Well, of course, central banks don't talk about that any more than the BIS does. We obtained a secret document. The minutes actually was a report by the staff of the International Monetary Fund dated March 1999, in which the staff explains that the members of the International Monetary Fund were violently opposed to changing the IMF's reporting requirements in any way that would distinguish central bank gold reserves from central bank gold swaps and leases. The staff report explained that central banks were against this because if the market knew how impaired central bank gold reserves were by gold leasing, the market would have very valuable trading information, would know just how much ammunition central banks had left for gold market and currency market intervention. So there's another document that shows not only that central banks are constantly trading surreptitiously, intervening in the gold market to control the price, but that they're deadly afraid of the markets finding out what they're doing, because that would just defeat all the market rigging they're doing if the public knew what was going on. Yeah, and that document is on our internet site as well. Nobody's denied it. It's not a forgery.
Right. So do you think that indicates that central bank physical supplies are running low, and that they're afraid that if the data on all of the trades they've been doing and providing liquidity to the markets is released, that there could actually be a run on the gold because people would see they don't have as much reserves as they thought they did?
Well, there was a run on reserves, of course, when the London gold pool collapsed in 1968. I'm not sure that I would say that gold isn't in central bank vaults, or is not in the vaults of central banks that have been trying to suppress the gold price over the years. I would say that it is certainly impaired by multiple claims. That's what gold leasing is about. Right. Much of gold leasing is just the issuance of certificates where they're credits for gold that remains in the vaults of central banks, and the certificates are traded around as if people holding the certificates own the gold, and it's all a polite fiction, but nevertheless it's a way that central banks have vastly increased the gold supply, or vastly created an imaginary gold supply with gold leasing. In testimony to Congress in 1998, the Federal Reserve Chairman Alan Greenspan said that central banks stand ready to lend gold in increasing quantities should the price rise. That is, Greenspan was admitting to Congress that the purpose of gold leasing by central banks is not to make a tiny bit of money in interest on the gold they lend, which is usually the explanation given for it. The purpose of gold leasing by central banks, Greenspan told Congress, is to keep the price down. There's another document there. So, but to your question as to, is there gold left in central bank vaults? Well, we know that many central banks have been acquiring gold lately, and they have announced their acquisition of it. Where has all the gold come from that has been leased or transferred to Asia in recent years? Very likely has come out of Western central bank vaults. And at some point, I think they will just call a halt to it because their reserves have been depleted too much. But, have we reached that point? There's signs that we're reaching it, but we don't know exactly. And this information is really top secret information.
Right. Yeah, it's just secret information. We can't know exactly, obviously. Yeah.
I mean, the gold price, what people ought to understand is that the gold price really is the secret knowledge of the financial universe. It is the key variable in the in the determination of all prices. All prices take their cues off the gold price and off interest rates and government bond prices. It is a determinant of currency values. It's a determinant of all other prices because it determines other currency values. That's why control of the gold price is really control of the world financially. It's the control of the valuation of all capital, labor, and goods and services in the world, and that's why the true disposition location of central bank gold reserves is our secret's really more sensitive than the location and disposition of nuclear weapons, because with nuclear weapons you can only destroy the world, and then what good is that? But if you control the gold price, you control all financial valuations in the world, all currency valuations, all equity valuations, all labor valuations. And if you don't believe me, you can read the minutes of a meeting in Secretary of State Henry Kissinger's office in Washington in April 1974, in which his deputy, Thomas O. Enders, explains to Kissinger that really control of the gold price is control of all the markets, because Enders explains to Kissinger, if you have the most gold, you can, excuse me again, if you have the most gold, you can revalue it from time to time. And in doing so, you change the values of everything else in the world. The transcript of that conversation in Kissinger's office, in which Enders is explaining to Kissinger why the United States must keep gold outside the world financial system and prevent the Europeans from remonetizing gold, because the Europeans at that point collectively had more gold now than the United States did. That transcript is still on the archive, in the archive on the internet site of the historian of the State Department. It's really a wonderful description of U.S. government policy toward suppressing the gold price, keeping gold out of the financial system to maintain the dominance of the U.S. dollar.
Yeah. So in terms of the futures markets, how many, for each dollar of gold that's being traded on the futures markets, what percentage of that actual gold exists, do you think?
Well, there was a hearing a few years ago before the U.S. Commodity Futures Trading Commission, in which the leverage in the gold futures market was discussed. One market expert, Jeff Christian of CPM Group, told the CFTC that the leverage in the gold futures market approached 100 to 1. That is, some bullion banks, some investment banks, were trading 100 ounces, nominal ounces, for every ounce they had possession of. Shortly after that, the Reserve Bank of India did a study in which it estimated the leverage in the gold futures market at 92 to 1. Again, that's on our internet site too. So it's pretty clear that the leverage in the gold market by the bullion banks, the investment banks, is overwhelming. It may not be as scary to them as it should be, because I think they basically are undertaking U.S. government and other government trades, and they're really just fronting for governments, giving them cover in the market, and are confident that they will be backed up by governments if they ever come into a jam. Really, that's what happened 20 years ago when the UK sold half its gold reserves. We believe that the United Kingdom was basically coming to rescue the bullion banks, who were caught dramatically short at the gold market's turn, and they would go down if the governments didn't back them up. And so the Great Britain obligingly announced that it would sell half its gold reserves. And making this announcement, it really ensured that Britain would get the lowest possible price for selling its gold reserves, because it was announcing its gold sales in advance. So everybody knew that, okay, there's going to be a big bunch of gold hitting the market here. That would deter a price increase. The UK was not looking to make a profit on its gold reserves. It was looking to knock the price down to save the banks at the expense, really, of public resources.
Wow. Who do you think is behind J.P. Morgan's silver futures positions?
Well, it's a very good question. And all I can do is speculate. Others could speculate better than I could about it. It could be a U.S. government position. It could be a Chinese government position. It could be a position for a number of central banks. I doubt very much that it is Morgan Chase's own position. I doubt it for two reasons. Number one, the monetary metals markets are primarily the playgrounds of central banks. And secondly, a few years ago, the top executives of J.P. Morgan Chase, Jamie Dimon, who's still chairman and CEO, and Blythe Masters, who was then head of Morgan's commodities desk, both made statements in response to complaints that Morgan was rigging the silver market, that Morgan had no position of its own in the silver market, that it was trading silver only for clients. Now, unfortunately, but predictably, the mainstream financial news organizations did not ask Dimon, Blythe Masters, or anybody else at Morgan, well, okay, who are your clients in the silver market? For whom are you trading silver? Just like the BIS will not tell you for whom it's trading gold, though it can be trading gold only for its member central banks. Well, here's Dimon and Masters getting up saying, oh, no, the bank doesn't have any position of its own in silver. We're just trading for clients. Well, are those clients governments? Are those your clients using you as cover for market regulation? Are they governmental? Nobody's ever asked them except GATA. And of course, we did not get a reply.
Right. Yeah. So there's also an investigation going on into it at the same time from the Department of Justice. Why do you think, if it's governments behind it, why would the government be investigating their own trading, basically?
This is a great puzzlement to me, and you're very good to zero in on it, because I can only speculate about it. I don't have a good answer for it. Now, certainly, the Justice Department has gotten convictions out of Morgan traders for spoofing the monetary metals market, and the traders who've been convicted, who pleaded guilty, confessed, said that they were manipulating the market with the full knowledge of their superiors. I have to wonder if that included Dimon and Blythe Masters. Surely, it seems to me that if Morgan has been operating as a government agent in the monetary metals market, as it operates as a government agent in the Treasury bond market, the firm being a primary dealer in U.S. government securities. If Morgan Chase has been a broker for the government in the monetary metals market, Morgan Chase and its traders certainly have as much dirt on the government as the government has on the traders at Morgan Chase.
Right.
I have to wonder, why would any Morgan trader give himself up so easily if they could dish some dirt on the government too. It's possible that this is happening because the charges against the Morgan traders seem to involve only the technique called spoofing, the entering and withdrawal, quick withdrawal of trades in an order sequence that misleads the market, misleads other traders. This certainly has happened. Nobody denies that spoofing is a practice, really a time-honored practice, I think, in the financial services industry. But in GATA's view, this spoofing is really a very small part of market manipulation. It's not the part of market manipulation that we've been interested in. We've been interested in direct intervention by the government to control prices. Spoofing can control prices to a certain extent, and it certainly can make money for the traders directly involved. But I don't think it's really the biggest part of market manipulation. It's possible that the traders at Morgan and other brokerage houses that were doing spoofing were front-running government trades. Maybe that's what the government doesn't like, that they were taking advantage of their inside information of what trades they were going to implement for the government and
Right.
running that for their own book. I don't know. This is only speculation, Meyer, and the case has been going on for a long, long time, and I despair of it ever reaching any kind of conclusion. Sometimes I think that the criminal case against the Morgan traders and other investment bank traders has been brought only to delay the civil lawsuits that have been brought against the investment banks for gold and silver market rigging, because the Justice Department has intervened in those civil lawsuits and gotten the courts to stay the cases while the Justice Department investigation continues. So the Justice Department, by requesting the stay and purportedly conducting its own investigation, has stymied the discovery and deposition investigations that ordinarily would be going on now, being conducted by the plaintiffs' law firms in the antitrust cases against the investment banks. So as far as I can see, the Justice Department investigation of Morgan and the other investment banks so far has served only to prevent investigation in the civil cases.
Yeah. We were talking earlier about the BIS, the Bank for International Settlements. Can you tell us a little bit about the history of that organization and how they got involved? As you said, they were the central bank of central banks, how they became that and how they got involved as well.
The BIS was started after World War I. The original intent of the bank was to be involved with reparations payments from Germany. It evolved into kind of a clearinghouse, a cooperative of central banks with an interest in international trade and international relations. It even kept trade going between the Axis powers and certain other governments during World War II. The Bank of England, I guess in 1939, facilitated the Nazi government's expropriation of the Czech gold reserves that were held at the Bank of England, and they did it through the Bank for International Settlements and certain numbered accounts. There's been a lot of criticism over the years that during World War II, the BIS was facilitating the Nazi government's financial transactions, helping to keep the Germans in the war through international trade. That's history. I'm not going to blame the BIS for doing that now. I'll blame the BIS for being the handmaiden of market rigging in other respects today. But it is sitting there in Basel, Switzerland, on the German border, in a big, shiny, oddly shaped building that has a trading room. There's one or two very interesting interviews that have been done over the years with BIS officials in which they acknowledged a gold trading operation, but they're not going to answer my questions. I suspect if the Financial Times or Wall Street Journal or New York Times really stuck it to them and demanded some answers and threatened to report the refusal to answer, they might get a little more information out of the BIS. But look, we know from the documentation, we know from the statements that even some BIS officials have made, like William R. White, the former head of their economic and monetary department, have made, that the BIS is very much involved in central bank regulation of the gold price. In fact, White, who's a Canadian, who's the former head of their economic department, gave a speech at BIS headquarters in Basel, I think about 15 years ago, which is, again, a document on GATA's internet site, in which he identified what he called, I think, the 5 major purposes of international central bank cooperation as implemented by the BIS, and one of them was intervention in the gold market.
Right. Are you aware of any sort of increase in futures contracts on the futures exchanges being taken for delivery? I talked with, oh yeah, go ahead.
Yeah, almost from the beginning of time, the New York Commodities Exchange's futures markets in gold, the COMEX, has been almost entirely a derivative market, that paper trading, a cash settled market. Just recently, just in the last few months, huge deliveries have developed out of the COMEX. This is a vast change. If as reported, there's really scores of tons being taken out of the COMEX out of the last few months. That's never happened before, and it signifies a big change in the gold market. It suggests that metal is, for some reason, is very scarce in London, and now they have to try to get it out of New York. On the other hand, London metals trader Andrew Maguire gave an interview a couple of days ago in which he asserted, really just on his own experience, I don't have documentation for it, excuse me, that the gold that is coming out of the COMEX in New York now, very suddenly, is actually gold that's been shipped over from London and now is just being shipped back to London from New York, indicating that this is, I think, more of the data manipulation that the gold market has seen for many years. I don't know. I know that's what Andrew says. He's much closer to it than I am, but certainly the transformation of the COMEX into a physical delivery market in the last few months is an enormous change in the gold market internationally, and signifies something very strange is going on.
Right. How does the price of gold affect the difference between the currencies, the US dollar and the currencies of BRICS countries? And what is the role in terms of BRICS countries trying to overtake the dollar?
Well, gold is a currency. It's traded as a currency. Its price is reported with currency market values. It was the world reserve currency at one point. I suspect it's it's going to be the world reserve currency again if people want an alternative to the dollar, because gold is the only potential alternative world reserve currency, because it's the only potential neutral currency. Nobody, no one country issues gold and can control its issuance. People don't want the Chinese yuan to be the world currency for political reasons. The euro is unsuitable because the European Union itself is so unstable. The British pound was the world reserve currency for many decades years ago, but Britain's economy is too small to support it. Gold really seems to be the only potential alternative world reserve currency, but it is a currency. People say, oh, there's not enough of it to support international trade, but that's a false analysis. At a high enough price per gram of gold, one lousy gold ounce could support all international trade. If a gold atom was worth $1 trillion, you don't need a lot of gold. You just need a lot of valuation in the gold, and that's really, you're right to point this out. This is the big geopolitical issue that's going on right now. Whether the world wants to continue being the vassals of the United States, because the dollar is the primary mechanism of U.S. imperialism in the world. Any country that is locked into the dollar system, that maintains dollars as its primary foreign exchange resources, is pretty much a tool of the United States. Other countries have realized this. That's why the European Union started the euro. It wanted a currency that it was able to control itself. That's why Russia and China have been buying so much gold lately. There's people who want to get out of the dollar system. Now, how soon will there be a change? I mean, it could be this weekend, it could be years from now. But the dollar competes not only with all other currencies, it competes with gold. And if you are dependent on the dollar for most of your financial transactions, you are at the mercy of the United States. We see the sanctions, the economic sanctions and political sanctions the United States imposes on any country that crosses the United States in foreign policy. Well, if you're living in the dollar system, and most of the world is, you're a subordinate of the United States. And, the rest of the world is growing to resent this a little bit.
Yeah. So how has the rest of the world pushed back against this, and have they criticized, obviously, the price manipulation of the U.S. government and Western
countries? Well, Russia and China have, China much more than Russia, but Russia as well. They have acknowledged the imperialism of the dollar and their interest in getting out of the dollar system. The Europeans less so, but the creation of the euro was a move toward European independence of the dollar system. It hasn't totally succeeded yet. I'm not sure whether it can succeed given the political divisions in Europe, but that hasn't been decided yet. But the euro is a very much a move away from the dollar by American allies. The acquisition of a lot of gold by Russia and China in recent years is a move away from the dollar as well. A few years ago, when WikiLeaks published a lot of supposedly secret U.S. State Department cables, among the cables it published, and which are kept on GATA's internet site as well, are cables from the U.S. Embassy in Beijing, China, to the State Department in Washington, which are translations of commentaries in the government-controlled press in China. And these cables are full of translations of stories about gold price manipulation and gold price suppression by the United States. The cables show that China knows all about the U.S. government policy of gold price suppression, and they show that the U.S. government knows that the Chinese government knows all about it, because the State Department got these translations from the embassy in Beijing. This issue is secret only in the mainstream financial news organizations in the West. It's certainly known among every major central bank what has been going on here, and I think it's known widely among a lot of people who pay attention to financial markets, but it's just too sensitive to talk about.
Right. That's incredible. So how might major Western central banks reset the current financial system and world order in order to prevent some kind of catastrophe if there was, let's say, a run on the gold or some other event which was threatening the current fractional reserve system, basically, which it is?
Well, there's a paper, a study written by a Scottish economist named Peter Millar. This is on GATA's internet site. There's a link to it on our homepage. Miller notes that governments long have used gold revaluation to devalue their currencies, to devalue debt, and to prevent interest on debt from going exponential and consuming the real productive economy, because in an interest system, interest on interest on interest eventually does go exponential. The U.S. government devalued the dollar in 1933 and 1934, and effectively in 1971 as well, by letting the gold price go. And that devalued the currency, it devalued debts as well. There is increasing discussion, speculation that there's too much debt in the world, that it has to be devalued. There's talk about, an old-fashioned jubilee where debts are forgiven. I don't think they'll ever do that, but a devaluation of currencies is effectively a jubilee. It devalues debts, makes them easier to pay. You could devalue the dollar by revaluing gold upward, or you could make gold a component of a new international currency, a component of the International Monetary Fund's special drawing rights. The SDR could be recomposed not only of the major currencies, but gold could be made a major part of the SDR at a much higher price, and that would devalue all the currencies. Central banks often have used gold when they want to devalue. They will, for probably most of the time, they will be trying to defend the value of their currencies to prevent a flight out of their currencies and a crash in their government bond prices and a crash in their stock markets. But at certain times when they need to devalue because debt is getting the best of them, they use gold to do that. The United States did that in 1933 and 1934. It devalued the dollar by, I think, at least a third. Other countries have done the same thing as well. We very possibly are coming upon a point where central bank consensus will be to devalue their currencies and devalue debt, and they will use gold to do it. Let me just take a sip here.
Sure.
The U.S. economists Paul Brodsky and Lee Quaintance 8 years ago wrote a paper, which is on GATA's internet site, in which they hypothesized that the real objective of the major central banks, and this was 8 years ago, was not to keep suppressing the gold price forever, as cranks and whack jobs like GATA were saying. But Brodsky and Quaintance said that their real objective was to redistribute the world's gold reserves among central banks in preparation for an inevitable devaluation of the world reserve currency, the dollar, and to redistribute the gold reserves in favor of those countries that had built up too many dollars in their foreign exchange reserves, so that upon a devaluation of the dollar, these countries with too many dollars in their foreign exchange accounts would lose on the dollar, but they would regain what they had lost with this upward revaluation of gold, so that they would be made whole. That gold was going to be redistributed around the world as a hedge for governments against dollar devaluation. I think Brodsky and Quaintance's hypothesis is looking pretty good right now.
Yeah, I mean, it seems logical. It's the same way an investor would use gold. What do you think the implications of a reevaluation of the price of gold by central banks would be for people who own gold right now, including any like negative things? Because you were mentioning the 30s, and we obviously know that in the early 20th century there was laws against the ownership of gold. So what kind of negative implications, as well as positive implications, obviously, would be the price, but would there be for gold owners?
Well, you know, confiscation is a concern for gold owners. There's a history there. President Roosevelt tried to confiscate gold in 33 and 34 from private hands. There was a rationale for that, because back in those years, gold constituted a big part of the currency stock of the United States. And we were going through a catastrophic debt deflation. The government didn't want hoarding of gold, and people were hoarding gold to protect themselves. And why shouldn't they have? The banks were failing. If you didn't have gold at home, you were sunk. You were losing your bank deposits because there was no deposit insurance. So hard coin at home was really the only thing you had. Roosevelt did get some of that gold back. He probably did not get most of it, because there's a lot of pre-1933 gold coins still floating around. But the United States did confiscate gold once, and made it illegal, made private ownership of monetary gold illegal in the United States until it was re-legalized in 1975. So there's a record of some concern there. Other countries have laws that enable the government to seize private gold. I think a few years ago, when South Korea had a currency crisis, it called on the people to turn their gold into the government and to support the government against financial collapse. And remarkably, South Koreans did turn their gold into the government, and the government was saved by the gold that was stored with the people. China still talks lately about storing gold with the people. It has been encouraging its people to buy and hold gold. So what does it mean, say, for Western investors? I put that question to the Treasury Department a few years ago. It took a lot of prodding. I finally had to recruit my congressman to compel the Treasury Department to answer my damn letter. But I wanted the Treasury Department to tell me, what is the Treasury Department's position on confiscation of gold? Well, thanks to my congressman, and I'll give him a plug, John Larson of 1st District here in Connecticut, I finally got like an assistant undersecretary for foreign assets control to answer me, and his answer is posted on GATA's internet site. He wrote back to me saying that the Treasury's position on gold confiscation was this: that under the Trading with the Enemy Act of 1917, which is the act that President Roosevelt claimed as authority for confiscating gold, and the Emergency Economic Powers Act of, I think it's 1977, the Treasury Department claims the power, upon a proclamation of emergency by the President of the United States, to seize or freeze any gold or silver related assets. But the assistant undersecretary told me I shouldn't feel shouldn't get too paranoid about it, because under the same two statutes, upon a proclamation of an emergency by the President of the United States, the Treasury Department claims the power to seize or freeze any goddamn thing it wants. So, land of the free and home of the brave. Now, I don't think this is probable, because gold in private hands in the United States does not constitute really any significant part of the money supply. And other than punishing gold owners for their foresight, I don't think a confiscation would accomplish anything for the government. And of course, I don't think a confiscation order would be complied with. If there was a bulletin right now that the government was confiscating gold, I would ask to call you back. Now, more likely, as Jim Rickards, who's a brilliant market analyst and geopolitical strategist, has pointed out, rather than gold confiscation, if the U.S. government wanted to punish gold investors for their foresight, it could impose windfall profits taxes on capital gains in gold. That would be much more practical for the government to do than to try to search through everybody's house and everybody's backyard for privately held gold. So, as the Treasury Department's explanation that I got from them some years ago suggests, the government has many mechanisms with which it can oppress us far more conveniently than knocking on our door asking us to deliver our gold.
Right. Yeah. It's kind of funny. Do you think you mentioned that some people in financial circles are aware of what we're talking about today, but a lot of people, like you said, in the financial press in the U.S. really are not. Obviously, now with all of the news coverage going on with the bull run, it's kind of coming up to the forefront of the conversation again. But I'm just curious, do you think it's just, like you said, it's just not it's not fun to talk about, or do you think if private investors in the West were kind of more aware of this information, it would really change the ability of what central banks get away with?
Well, obviously, the U.S. government and other central banks are very much afraid of any widespread public understanding about gold's role in the world financial system and its relationship to government currencies. If gold was unimportant and it didn't matter what the public knew, governments would not be trading gold secretly, and they would not be withholding gold-related documents from nonprofit groups like my own. They would be fully transparent about this, but instead, gold is really the most sensitive secret governments have. So obviously, governments fear public knowledge, but I'm not sure governments should fear it so much, because the gold issue is a little complicated. If Americans are starting to hear about the gold price increase, the rally in gold and silver, and gold going past its historical record price, if they set about to buy gold, I suspect most of them would just shoot themselves in the foot. That is, they would buy paper gold, they would buy derivatives, they would not buy gold in any kind of real metal form, or would not invest in a security that was unalterably backed by gold. They would probably invest in the Exchange Traded Fund, GLD, which is really just a paper instrument run by the bullion banks, and it's a fund that's really used to short the market by the bullion banks to knock the price down when they need to knock the price down. If you want to be a gold investor and you buy GLD or SLV, the Silver Exchange Traded Fund, you might as well just flush your money down the toilet. If you want your investment to appreciate, you've got to connect it to something that has real metal that you can get your hands on. I think most people going to invest in gold would not understand that. In fact, we're already seeing a big investment growth in exchange traded funds in gold and silver, and some of those funds are really just derivative instruments, and they're not really backed by gold. And an individual investor can't get his hands on the gold in the fund that he's investing in. Some exchange traded gold and silver funds you can get even small amounts of gold out of. You can convert your shares for deliverable gold. but the big ones you can't. So I'm probably a little more worried by any public interest in gold and silver, because I'm sure most people will just become agents of price suppression by putting it into the exchange traded funds that the bullion banks, the government agents, use for price suppression.
Right.
I mean, if you really want to beat them, a good part of your gold and silver investment's got to be in real metal that you place it, in a vault somewhere, and you can hold, you can touch it, or you can have it with, a gold vaulting service like Gold Money or Bullion Vault or something like that. Then you can have some confidence that there's real metal there, that you can get your hands on it, that it's not being turned into derivatives, it's not being hypothecated and rehypothecated. And I suspect that the increased public interest in gold right now may help the other side, because people will put money into the instruments that are being used for price suppression and not into real metal.
Right. Yeah, that's a great point. I never considered that. Well, I guess we can leave it there for today. We covered a lot of ground, Chris, and I really appreciate you coming on the show today. I learned a lot, and thanks for doing what you're doing with GATA. It's great work.
Well, I appreciate your interest, Meyer, and I'm very grateful for the opportunity to harangue your audience.